Hi, it's Rick Riggs with Obsidian Wisdom. Welcome to another Retirement Readiness Thursday. Today, I have a treat for you. Today, we're going to follow a do it yourself investor. So, normally, if you're a do it yourself investor, you have built the nest egg on your own. You probably use index funds. He's chosen a few stocks even himself, and he's been able to build up over $1 million in his fund. But as you retire, so Robert had recently retired. His wife wasn't, I believe she wasn't working at the time, and so they were trying to figure out, hey, how much money do we have to spend? How do we create a withdrawal strategy and income plan from this money? And then we went over all the goals that they had for themselves, places they wanted to go, things they wanted to do. And then we took in some things that they just don't consider. And normally that's going to be our healthcare expenses, inflation, things like that. And then we talk about risk and investment markets and sequence of returns, all fancy jargon, but I'll go through it for you. And then normally when you add the risk in, that's when we start feeling overwhelmed. Like I don't want to mess up here, but then I don't want to mess up there either. And so we got together, we went through how to keep more money, simplify it so that you didn't feel overwhelmed. And then they were able to kind of take that plan and implement it on their own because they had done a great job the entire time. And so that's what we'll focus on today. So I will share that with you. Let me go ahead and share my screen. And then we'll go through the plan. Some of the questions that we normally will answer when someone is coming and they're basically, look, I've been doing this on my own. What will we kind of be looking through? Normally, it's going to be number one is like, hey, what order should I withdraw the money from? Number two is how do I manage taxes? And the number three, when should I start Social Security? More times than not, if you're focused on, hey, do I run out of money? Those are normally going to be the three places that we start. And then we always talk about when we're I always say always, right? Always say always. You saw what I just did there. But when we do talk about, hey, how do you reduce taxes? We're normally deciding, should I pay more taxes now or later? Right? That's ultimately the question. The question isn't whether we pay taxes. We're going to pay taxes. The question is, should we pay it now or later? And for most of us, high level, the first thing that we would have to decide, do I think I'll pay more taxes later or do I think I'm going to pay more taxes now? If I think I'll pay more taxes now, then deferring it to later is probably going to be your best choice. If you think you'll pay more taxes later, then locking in the taxes now is going to be your best choice. So that's normally the very first thing that we look at. From there, we start deciding where is the money located, and that's called just tax diversification. That's all tax planning is. You and I recognize that our investments should be diversified. We probably should have our risk diversified, but a lot of times we don't think about our taxes being diversified. And so that's normally going to be the two things we look at from a tax perspective. Then when you're talking about Social Security, I'll go through a handful of things that we normally think about, but that is very unique for each one of us. And from there, we normally will go through the how do I remove the stress, right? What is it that stresses me out the most? And then what can I do to alleviate that stress? So in this plan, you can see that where we're basically at is we're at a 69% probability of success. The goal is to always get to, I mean, always strong. The goal is to get somewhere over 70%. All we're saying here is this is called a Monte Carlo simulation. Very fancy way of saying we run 1,000 different scenarios, and then we see how many times do we still have money at the end of our retirement. And then you can see here that what we're looking at is we're basically saying, look, this is the amount of money that I have. You can see we have a median of 1.5 million. And then you can move along and you can see that there is a certain probability that we'll have the money left at 90. And that there is a 5%, as you can see, there's a 5% chance that we'll have $0. There's a 5% chance we'll have almost 6 million. And then there's that 50% confidence interval will be somewhere between 0 and 2 million. And so the median is then normally around that 950,000. We're saying that the majority of the time, when everything happens, all of the different scenarios, that we'll probably have money left over at the end of retirement. And so normally the goal is to get above 70. So we were able to get them started on that. And then from there, they can make the adjustments that make the most sense for them. As you can see, they had the majority of their money was going to be inside of their 401k, and I'll go through that with you. They did have a Roth that was set up, and then they were able to put 120,000 in there before they retired. Currently, we are 61 and 63. All right, so you can see our net worth, 2.4 million. It has the investments as half of it, and then it has the real estate as the other half of it. Interesting enough, when we started looking at their investment portfolio, they were actually a little bit more aggressive than I would imagine someone to be that's closer to their 60s. But that's not uncommon because normally what happens is we're pretty far from retirement. So the idea is, well, I need to have my money invested in a way that helps me to make money. And then generally speaking, I know that the more risk I have, the more opportunity I have for growth. Not that it's a one-on-one, right? Because if that was true, then we would just all invest in penny stocks. Can't get riskier than that. So then surely that's going to have the highest return. You and I recognize that's not the case, which means ultimately it's not that we're just taking risk for risk's sake, but it is recognizing that there is levels to it. And so as much as we can protect ourselves, that would normally be the idea. And so I mentioned to them, I was like, hey, we can probably find a way to adjust certain parts of the plan so that you can take the foot off the gas on your investments. That yes, since the Great Recession, you've had a phenomenal return on your investments. It was a great opportunity and environment. Everything from very low interest rates. It makes it very easy for companies to reinvest and make more money, right? If you can get money at like 1, 2%, then that means you only need a 3% idea to make a profit, which that's not very hard to think of that. And then the opposite would be true is if we had high interest rates, well, that now requires me to have a 10% return on my investment idea to cover the rate of the money, which is a little bit more difficult. That's why businesses struggle in high interest rate environments. Ultimately, when you're looking at the past 10 years, it was a really good time. And then they took a little bit of a haircut during COVID, but they were able to recover from that because that was the shortest recession, I believe, in the history of the United States because it was such a short amount of time. They've had a great about 15 years. And so the idea is, look, it's been working. Why wouldn't it stop? And then I'm like, hey, economically speaking, the environment is changing. So it is something that we would want to be protecting ourselves from. And so I was like, we should probably take our foot off the gas ever so slightly to make sure that we're not overexposed because that's really the issue that we have. I know I was reading an article, I think the guy's name was Victor, and he was talking about in the first quarter, he had just retired and he had lost $58,000 in 2 days. And I'm sitting here thinking, like, if you just retired, and I get it, it was a very turbulent environment. We're trying to figure out the whole tariffs and all this other stuff. And that the market had lost $6 trillion as a whole. But at the same time, if you just retired, should you be that exposed to that $6 trillion, right? Like that's the idea. And so when you're dealing with someone that doesn't have as heavy of a fear of risk, I'll say, we then normally lean on what's called the risk threshold. So you have your risk tolerance, which is like how do you sleep at night when you're dealing with the risk, and then you have the risk threshold, like based on your own unique situation, how much risk should you be taking? Like, sure, you jump out of planes and you go skydiving, you do all this stuff, that's wonderful, but based on your own unique situation, should you be taking that much risk? So that's your risk threshold. And so we leaned a little bit more on that. And so we normally use a combination of the two, where it's like, all right, well, I can understand our risk tolerance, but then our risk threshold, or I can understand our goal, and based on that. And so for them, I was like, let's just see if we can just take a teensy bit of off the gas, and then I will show you how we can make up the difference. And so they're like, all right, we can do that, right? That's normally going to be when I see with do-it-yourself investors, is normally one of the two. It's either we're too conservative, so it's like we're working so much that our money is not, or we're too aggressive where we're overexposed, and then if something happens, we may have to go back to work when we weren't expecting to. And so they were very cool with that. So I did appreciate them being open to that. And so a lot of the times when you're doing such a great job, it is difficult to even imagine like, hey, what would happen? So I do talk a lot about risk for them, as we made very small changes. But you'll notice, interesting enough, their probability of success increased, even though the balance in the estimated portfolio decreased. Right. Very interesting, right? And so what we're talking about is, even though we may have less money because we're not invested in a certain way, the reality is that portfolio, when you have a recession once every 10 years, it was going to cause some issues. And so we were able to protect ourselves. So we did adjust them to the balance. We kept it with the full retirement age of 67. And for this particular one, and for you, the retirement, it really does depend on so many things. But high level, I do normally tell people it takes at least 10 to 12 years if you wait to take the Social Security at like your full age or at 70. And so normally what it is, and I'll see if I can even find the image, I can show it to you, but high level what it is that there's a chart, and then you basically say if you started at 62, then you would have received whatever that would have been. And then you get an 8% increase every single year, which ultimately means that if you waited till 67, if you then were able to take that difference, it normally takes, like I said, about 80 to 82. That's if you would at a minimum have to feel like, yeah, we have a very long, healthy family dynamic. We feel like we're going to be around forever. If you're around 80 to 82, you're going to make that difference up and then some. And then if you wait till 70, it's around that same still time. So if it's around 80 to 82, you'll then surpass it. So if you're confident about that, that's normally going to be the break even point. And so you'll see the numbers is normally around like 77, 78. You'll start seeing it getting ever so close. So first thing that we normally look at as far as maximizing Social Security is what I believe my life expectancy is, right? Like that's the first thing. The second thing we will look at is where am I going to take the money from while I'm not taking Social Security? Because that is the second thing. They're called your bridge years from 62 to 70. How do I bridge my income to make it to 70 if that's what I wanted to do? If you don't have multiple streams that you can use, then it's normally going to be the best option just to take Social Security because you still need the income, you still need to afford it. Now they were 61 and 63, and so they had just retired. But if you wanted to wait, then that would be a possible option. Like, hey, well, I love my job, it's not very stressful, I get paid pretty well. I'm going to be around anyway. So then, sure, if you're going to be around 65 to 70, then we can wait to start Social Security then. And so normally you would look at that. And then the last thing that we normally look at is if you're a couple, there is a dynamic of spousal Social Security, which is the idea that, all right, well, our retirement plan has two incomes, and that's how it's been built, and our retirement is going to be fine. Well, what happens if something happens to one of us early? How does that impact the retirement for the other spouse? And then if the answer to that question is like, oh, that would ruin it, then sometimes what we'll try to do is when your spouse, it's like 10 years married and things like that, you're able to use your other spouse's Social Security, so the higher one. So in this particular situation, right, the one spouse she wasn't working, she hadn't worked, and then the other spouse was the income earner. He was, I think, he was a retired engineer, and so in that type of situation, he would normally wait the longest because the idea is if my spouse is going to get a smaller amount, if I'm able to wait, then that means if she gets half of my Social Security, if I pass, she's in a much better situation, right? And so normally in those type of situations, the person who makes less will go early, if at all, and then the person who makes more will go later. And if that is an option that you can do, then a lot of people like to do that as well because it ensures that your spouse is set up in a way that works. All right, so then based off of that, we'll go through the tax strategy because that was normally the first place that you end up looking at when you have a lot of your money that's set inside of your pre-tax account. It means it's not going to be taxed yet. And so you can see that the adjustments that we made, we're able to give them $270,000 more in tax adjusted ending assets. They're to pay about $120,000 less in taxes, and they're able to withdraw about $700,000 less than they needed to. And there's two main reasons that works that way. Number one is if you're going to live on, I don't know, $100,000 a year, to make the math easy for me, that if you had to pay taxes off that money, then you'd have to take out whatever, like $120,000 to cover the taxes. Well, if you only have the money in tax-free accounts, then you actually take out $100,000. You don't have to take out the extra amount to cover the taxes so that you net your lifestyle. The other one is, of course, we have things like required minimum distributions that pop up later on in retirement. And when they start popping up, we have to take money out, and it's more and more the older we get. And for a lot of people, it ends up being an amount that they just wouldn't have spent. And so it's normally going to be the second thing that we end up looking at. And so you can see that what we did here is early in the retirement, we basically said anytime their taxes would have been below 10%, that's what this teal line is. So anytime the break would have been below 10%, we are going to do a Roth conversion. So we're not going to pay less than 10% in taxes, basically what we said. And so anytime that we're below that, we're going to move some money from a 401k and move it into a Roth IRA. So we're going to do it back to a Roth and do the Roth conversions. The idea of that is later in retirement, if you have Social Security going, you have your RMDs started, that it could push you into a higher tax bracket because of all those income streams stacking up on each other. And so for this particular plan, we were able to do that. As far as when you look at that situation, normally what we're saying is the withdrawal strategy. For this particular one, we're going to take the money from our taxable account first, that worked the best for them. And all your taxable account is your brokerage account. It's just money that you have in your Robinhood account or your Schwab account, wherever your personal kind of investments are that are outside of your retirement accounts. And then your pro rata just means I'll just take it evenly from all of my accounts after that. And that gave them the most bang for their buck. And so that was the withdrawal strategy that made the most sense for them based on where their money is at. And that will, generally speaking, be different for each of us because it does depend on where the money is at, where you'll be able to get the most bang for your buck. So that was for them. So they were able to adjust that plan, and they had that. You see, we had the bracket fill up over 10%, and then they were good to go. So that was the tax strategy we put in place to put more money in their pocket, where we were able to reduce how much they actually had to spend. Which was the goal for them, because even though basically it was the way that their lifestyle was, and I'll show you what some of the things were that they had planned, and I'll show you where that ended up going. As far as the debt proposal that they had, they didn't. I think they had all the credit cards paid off, and they had a house and two cars. They had a house and two cars. Yep. And so the plan was, hey, let's go ahead and let's see if we can lower what our monthly expenses are. So that way we're able to work through these bridge years a little bit more efficiently. And right, like that's the high level idea. So if I'm going to do these Roth conversions, and then I'm going to be living off of these accounts whenever I'm doing the Roth conversions, we could use that money to then pay off some of the other bills. So that way, when you're done with your Roth conversions and you have Social Security and everything else started, it's possible that you're able to be in a position where you're able to depend on your investments less, and then you're able to expand how much your money ends up lasting. And so for them, what we ended up doing is we said, what if we doubled your mortgage payment? You only had, I believe they only had like 5 years left. They had like $80,000. Yeah. So they had like $78,000 left. They had like 5 years. And so we said, what if we just double it? And then we can be done that much quicker. So we can be done in a couple years. And so that was the idea. So we shaved off a couple years, 20 months. And then we weren't as concerned as much about the savings because they already had great interest rates because they have great credit. But that's what we ended up doing. We got rid of the mortgage, so that way we had one less large expense. And then they have the ability to move or downsize. They can sell the home and use that as another income source. But they don't have to. But at least we gave them a little bit more flexibility. I'm someone who likes the idea of flexibility. If you ever played a game with me, I almost always choose my strategies in a way that allow me the most options, because I don't know what you're going to do, right? You're unpredictable. But at least no matter what you choose, I already have maybe two or three choices lined up for me. That's generally how I do most things. And so when it comes to making a plan, I feel the same way. I would like to have the most options. Whether Congress does whatever they do, or whether the world is doing whatever it does, I am able to give myself the most flexibility. I'm not tied into anything for the next 5 years or so. I'm able to adjust as the world adjusts. And so that is where what the thought was on that. And then as a result, you're like, boom, you have that done. And then you can get rid of the cars as well with that additional amount of money. And then you won't have any of those bills later in retirement, which again, as I mentioned, gives you a little bit more flexibility when you're dealing with everything else. So where now we have a couple things. One is we're going to have the bills gone. So I don't have to spend that money if I don't want to. But then two, I also have done my Roth conversions. So I don't have to take out that money from my 401k when I have the required minimum distributions. Because if we don't take it out, then we have a 25% penalty, which obviously sucks. So we don't want to give the government more money than we need to, but then we also weren't going to really spend the money because we had a simple retirement, or at least later on, we don't want to spend as much. And so those were some of the ideas that we were able to go through for them. And then we'll go back to the main page. All right, and then of course the spending normally is the retirement spending smile that matched them because based on the goals. And as I had mentioned before, the idea of the retirement spending smile is that most of us don't actually just spend exponentially more every single year in retirement. We spend more early in retirement. We take all the trips, we do all the things, we remodel the house, we volunteer, we help, we're very active, we're doing a lot. And then at some point we sort of get tired of being stuck in the airport or having trips canceled or getting sick or whatever happens. And so we start taking it a little bit more local. We still do things, but we're just a little bit more local than we used to be. And then that is normally going to decrease the expenses. So that's the smile, right? We start off high spending, and then it decreases and it flattens out. And then later in retirement, we normally have healthcare expenses. So then it increases again later in retirement. And then when you look at that spending, that gives you the smile, which most of us have. There's always exceptions, but most of us are going to spend that way. As far as the goals that they had that helped me with that, right? So we had the healthcare expenses, of course, we had the long-term care, of course, in there. Now for them, we had turned it off because it just wasn't one of the things that they were concerned about at the time. But I like to always show people what the number is because it ends up being depending on which one that you end up choosing. If you have in-home healthcare, it's about 75,000 a year. If you have assisted living, that's about 71,000 a year. If you're a nursing home, that's about 127,000 a year. Then that's the national average. Now we can always look it up in the local area and then adjust it to the actual numbers that would be places you would go. But the nursing home, the reason that's most expensive is because that's around the clock care. The assisted living, the reason that one's normally in the middle is because you're leaving your house and you're going to more like a group offering where they help you a little bit. Maybe you have almost like a physical therapy kind of a vibe. And then the one where they come into your house, where you have the in-home care, that one ends up being kind of the middle expense because however many hours you normally would have someone come to your house on average, you can adjust that. You can have them come once a week if you want. You can have them come 3 times a week, however that looks. But that ends up being slightly more expensive than being in like a group, but then it's definitely less expensive than around the clock care. And so I always like to show people just what those numbers are because the numbers say that 7 out of 10 people, 65 and older, will have at least one long-term care episode. And so then when you talk about the vacation, they were talking about $10,000 a year, and then we had adjusted it where it was going to be every other year. And so that's how we did that for them. And then they wanted to go until 75. So they wanted to do that for about the next 12 years, which is aligned with the retirement spending smile. They didn't want to start funds and gifting to the grandkids. That was 3,000 a year. We are thinking about a golf membership, so that's why that's a placeholder. And then the missus, she was going to join a yoga, and that was about, it was like $100 a month, so like somewhere around there. So it's about $1,000 a year is what that ended up being. And so those were the goals. Based off those goals, I was like, okay, we're probably going to be spending more like a retirement spending smile. And so you can see that basically the steps that you would take is, of course, it's a great place to start is I'm just going to be investing my money because I want my money to work. Time is on your side the earlier that we start. There is a great story. A gentleman, his name was Ronald Reed. And long story short, Ronald Reed, he was a janitor. And when he had passed, no one knew that he had, I think it was like $8 million in his account. So people were like, wait, what? It was like, yeah, Ronald Reed had $8 million in his account. Everybody's like, well, how did the janitor have $8 million in his account? And I will share that tab with you. The long and the short of the story is he kept his money in the market. That is time in the market. I can show you lots of graphs that just shows you if you leave your money in the market, historically speaking, it's going to work out in your favor. So Ronald kept it pretty chill. And so the way the numbers would work out is basically he would have invested, let's say $300 a month over a span of like his whole life. So like 50 years, like 50 or 60 years to get to the $8 million. And then when you looked at his portfolios, he had invested in what would be called blue chip companies, which are going to be like your Fortune 50 companies, huge companies that it's very unlikely that they would have a huge year of growth because they already have so much market share, but it's equally unlikely that they would just go away, right? Like if like if AT&T or Google or Apple, Nvidia, these trillion-dollar companies, if they went away, we would imagine something crazy is going on because these are global companies. So those are the ones he invested in. So he took modest returns, but he allowed the money to keep growing and working for him. And that's how you end up, right? As a janitor. So I said he earned about $50 a week, probably invested 40 of it. That's what a friend said. I mean, it's hard to do the math, but the math says it's about $300 a month over a span of like 50 years with the returns of the average of those blue chip companies. And he loved dividend paying blue chip companies. And so among you can see him. He had like Procter & Gamble, JP Morgan Chase, General Electric, Dow Chemical. All these are companies that will probably just never go away. And you can see that it's not the getting the money is, relatively speaking, it just requires us to consistently do it, but it's definitely doable. And then when we have the money, now we have to turn it into the income. And that's where it takes a little bit more wisdom as far as like, I don't want to pay too much in taxes, but I also don't want to have so much money left over that I didn't enjoy my retirement because I wasn't sure how much I could spend. Where you want to be able to have a little bit of confidence where it's like, yeah, we can take these trips, we can do these things, you can have this membership, and then you can adjust the way your taxes are, and then you can have the most control over your plan. And for most people, that's where they want that second opinion. If you've already invested all the money on your own, normally speaking, you just want to be able to make sure you make the right decisions. Like I don't want to get screwed by the government when it comes to Medicare, and then they raise it because of Irma, and I took out money to remodel my house in the wrong year, and I didn't know that was going to be a thing that they looked at. All that kind of stuff when you're making decisions on your income is normally where that second look ends up coming at. All right, so I think that is it. Let me go back to the plan. Yeah. I believe that was. I always love that example of Ronald Reagan. And so, all right, so then basically, when you look at that, so we're able to start paying off the bills, which will lower their monthly expenses. We did take the foot off the gas for their investment allocation because I didn't want them to be overexposed. And then we were able to go ahead and say we'll do Social Security at our full retirement age, which was 67. We have the debt plan in place to get the house paid off, doubling it. We have the tax strategy in place for anytime taxes were below the 10%. And then our spending was just matching what they said they wanted to do. And so that's where you get the retirement spending smile. And then that gives you right around that space that you need to be at. Now, naturally, they are able to make any adjustments that they want, right? This is just based off of this based in time. So now when you look at the numbers, you get to decide, hey, based on that, do I want to have that golf membership? Do we want to take those same trips? Do we want to simplify it a little bit? But you're able to confidently say, I know how much money we can spend and I know how we're going to set it up. I know how much we're going to roughly pay in taxes and how much we're going to be able to free up and save. And so that's what we would normally do for them. All right. And then based on that, if you are interested, every single Wednesday, I do a retirement. No. So that's what I do on Thursday. Every single Wednesday, I do my worry-free Wednesday. We go over the 5 hidden dangers to a wealthy retirement. And so all you got to do is go to obsidianwisdom.com. You click on the I want a worry-free retirement, and then that will take you to where you sign up for it. It is free, and I do it every single Wednesday live. It's also at 8 o'clock, so I do it each week, and then we'll go over the 5 hidden dangers to wealth retirement, and I will share with you exactly how I would design the plan to make sure that I don't have to deal with that. And then the Zoom room fits in 100, so that's just why it's the 100 spots. And then you can decide if that makes the most sense for you. We can go from there. All right, let's see if we have any questions, and then after that, I'll let you all go. Ronald, good to see you, my friend. It says, if you want to build confidence to implement the plan as presented here, preparation is key. Yes, Ronald, I agree. So I have this corny thing that I run around my house from, Scar and the Lion King, and he's like, be prepared. And I'll do that all the time. My kids are like, stop it, Dad. And I'm like, it's okay. Like, it's okay. I'm just going to do it. And I'm like, that's my dad joke of the day. And then they'll be like, that's your 5th dad joke of the day. And I'm like, I get it. And so I do. I 100% agree with you on that ultimately the difference between success and failure in retirement is being prepared for opportunities and challenges, being prepared for both of them. That there are going to be opportunities where we're able to set ourselves up for future success. And the way I normally describe it is in the worst year where there's a huge recession and everything is going bad, there will be one company that has made more money than it ever made in its entire existence, right? That's just the way that the math works out. And then in times of huge, amazing economic growth, now there will be a company who files for bankruptcy that year, right? And that's just the way it works out. And so ultimately it's less the circumstances and it's more how prepared we are and what we do in those different times. That's what separates us, because it's not that any environment means everyone wins, and it's not that any environment means everyone loses. So I 100% agree with you on that, Ronald. Thank you, my friend. All right. As always, I'm thankful for the time that we have together, and we'll do it again next Thursday. And so I hope everybody's having a great summer. And until next time, stay safe and enjoy life.